Welcome back. Now, the Congo Republic will start producing 50,000 barrels of oil per day from its Bonga Kayo field from the end of this year or early next year. The Central African nation has staged a dramatic turnaround from years of decline in crude oil production. Total output currently stands at about 280,000 barrels per day, up 15% on 2016's average output level. And here in Nigeria, the central bank on Tuesday kept its benchmark interest rate at 14% hours after the National Bureau of Statistics released its first quarter GDP numbers, which shows 0.52% contraction on the economy for the period. This was in line with the expectations of most analysts. Now let's get a sense of what analysts outside our shows think about all of these. I'm being joined by the head economic research at Ecobank Group London, Gaimin Nonyani. Good afternoon, Gaimin. Thank you very much for joining us.
Good afternoon.
Now, were you also expecting a do-nothing decisions by Nigeria's central bank in its rate decisions this time?
Yeah, absolutely. It was very much expected, and this is a trend we expect the central bank to continue with throughout the rest of 2017, because raising rates would have been counterproductive. It would have adversely affected aggregate consumption, and given that the economy is still in a recession, it wouldn't have been good for growth. And then at the same time, reducing rates, of course, would have increased inflationary pressures. And we know that inflation is already high, and it will somewhat reverse some of the gains we're seeing in the currency so far.
Now, Nigeria has so far recorded some positive economic numbers. We have seen an improvement in the PMI. Inflation has been trending down, albeit slowly. The GDP number released on Tuesday shows the economy contracted 0.52% in the first quarter of this year. Now, the exchange rate seems to have stabilized also. Putting all of these positive indicators together, what does that tell you about Nigeria's economy? So why would you expect this interest rate to remain steady the way it is for the rest of 2017?
Well, because the economy is very much fragile at the moment. The exchange rate has stabilized largely because since February this year, we've seen the central bank intervene aggressively in the foreign exchange markets. And then at the same time, it's created a number of foreign exchange windows which have helped to ease liquidity. So the issue was with liquidity. Foreign exchange liquidity was hard to come by, and now following all its all of the approaches that it's taken so far, it's helped to boost liquidity in the markets. And that's largely thanks to the rise in oil prices recently and oil production. And for as long as oil prices remain like that and oil production continues to increase, barring any shocks in the Niger Delta, we expect this trend to continue throughout this year. But the question is whether this is sustainable. So that would be the concern.
Now, what's your general assessment of this aggressive intervention by the central bank on the foreign exchange market?
Sorry, I didn't get the question.
Your general assessment of the central bank's aggressive intervention on the foreign exchange market?
Yes, well, it doesn't want, it's doing this, in other words, it's trying to reduce the spread between the parallel market and the official exchange rates, the bank interbank rate. And that's largely because there's still a shortage of foreign exchange coming into the economy. Investors are still uncertain, and so it's taken so much control in the foreign exchange market because it wants to reduce the spread and reduce any form of speculative activity that we saw last year. This has helped, and it appears to be succeeding. It's pumping a lot of money into the banks, and at the same time, it's reducing Naira liquidity through open market operations. But the question is whether this is going to be sustainable, and we don't think it will be sustainable unless it finds a way to unify all these rates in the markets and focus on trying to boost its attractiveness overseas.
Now, how do you think central bank should be able to go about this in terms of unifying this exchange rate, because that seemed to be a challenge they are faced with, having multiple exchange rates?
I think it's going to be a hard one. I won't expect them to do that anytime soon in the near term, largely because their current stance is working for them. It's working for the economy. We've just seen, like you just mentioned, the economy is now, the rate of contraction in the economy has eased somewhat. It's now 0.5% compared to last quarter, to Q4 2016, when it was about 1.7% in terms of the contraction. So it's working, and so I don't think that they'll do anything to jeopardize that anytime soon. But I think if there should be another major shock to oil prices or oil production, then I think that the central bank would have to revert and proceed with more devaluation in different segments of the economy.
All right, thank you very much for your time, Gaimin. Gaimin Mondiane is the head economic research at Ecobank Group, London. And Tunisia's central bank raised its key interest rate from 4.75% to 5% today, the second hike in a month, as it tries to halt a slide in the dinar currency, which has fallen to historic lows against the euro and the dollar. The central bank had previously raised the rate to 4.75% from 4.25% on April 26. And Ghana is seeking better terms for its debt support program with the International Monetary Fund as the parties discuss an extension of the agreement beyond an April 2018 deadline. The government will agree to extend the deal in return for a bigger credit facility. IMF says the West Africa's second biggest economy will take longer than planned to meet the objective of the program. IMF is reviewing progress on its $918 million extended credit facility program that it agreed with Ghana in April 2015 after lower prices for the nation's gold and oil exports caused debt to balloon and the currency to weaken. The government consented to fiscal and monetary reforms, including narrowing the budget deficit that exceeded 10% of gross domestic product from 2012 to 2014. And that's it on the program for today. Thank you very much for watching. I'm Chimizie Obi Iwago.